Okay, hello everyone, and welcome to this Trader's Log webinar. Thank you very much to Dan Blystone, and thank all of you for attending today. My name is James Chen. I am the Director of Technical Research and Education for FXDD. We are a global foreign exchange broker. Now today, on behalf of Trader's Log, I will be providing you with a webinar on a specific strategy that I use for trading in the Forex market. Now this specific strategy happens to conform to my general approach to the market, which I'm going to talk about in a second. And I'm going to be showing you some charts with examples of where the strategy works. And then if you have any questions, please feel free to ask them at any time by typing in on your GoToMeeting platform. Okay, so let's get started real quick. Now, let me go ahead and forward the slides a bit. Okay, as always, before I speak, I would like to provide just a quick risk disclaimer. Foreign exchange trading carries a high level of risk that may not be suitable for all investors. Do not invest money that you cannot afford to lose. Educate yourself on the risks associated with foreign exchange trading and seek advice from an independent financial or tax advisor if you have any questions. I'm just going to give you a few more seconds to read through that, and then we will move forward. Okay, once again, today's topic, well, not once again, but today's topic is multiple time frame Forex trend trading. So I'm going to be talking about an approach to trading in the Forex market using a trend approach that utilizes different time frames. In this case, 3 different time frames. And for those of you who've heard me speak about this before, I have spoken about this particular strategy on several occasions before, only because I believe it's a very high probability strategy that I use quite often. So let's move forward real quick. For those of you who are not familiar with who I am or what I do, very quickly, my name again is James Chen. I am the Director, let me move back one. I am the Director of Technical Research and Education at FXDD. We are, once again, a global foreign exchange broker. I've been actively trading the Forex market since pretty much the beginning of retail Forex. This was probably around 2001, year 2001. Prior to that, I was trading equities and futures, and I've been using primarily technical analysis throughout my trading career. I am a Chartered Market Technician, or a CMT, which is a designation for technical analysts and traders. And I am a registered commodity trading advisor registered here in the U.S. with the National Futures Association. I publish daily and intraday currency analysis you'll be able to find. Actually, it's not at FXDD anymore. It's at Forex Live, which is our sister website that provides a lot of analysis 24 hours a day on the Forex market. So again, it's forexlive.com, and you'll be able to find my analysis there, usually in the Asian session. I've authored numerous articles in these publications, as you see here, and I've been quoted on a regular basis by Reuters News, Dow Jones, Bloomberg, Associated Press, International Herald Tribune, as well as many others. And I'm the author of 2 books, Essentials of Foreign Exchange Trading and Essentials of Technical Analysis for Financial Markets, both of which were published within the last couple of years by John Wiley and Sons. Also, I have a DVD set on fxstreet.com, and it's called High Probability Trend Following in the Forex Market. Okay, so that's enough about me. Let's move forward real quick with the main part of this presentation, which is multiple time frame trading. Now, before I get to the multiple time frame trading approach, I would like to quickly provide you with my philosophy and my approach to my general approach to trading in the markets. Okay, so hopefully you can get something out of this. In terms of entries and exits when you're trading, okay, there are basically, as far as I'm concerned, there are 2 ways. There's 1 way to get in, 2 ways to get out. Okay, so in terms of entries and exits, there's 1 way to enter, as far as I'm concerned, in terms of the highest probability entry method, and that is at the right direction at the best possible price. Okay, so the way to get into a trade is in the right direction, and we'll talk about how to determine that, and it mostly has to do with trend, and at the best possible price. And how do you determine the best possible price? It's usually by getting in on some type of a pullback, some type of a correction within that trend, some type of a retracement. within that trend. So again, the right direction at the best possible price is where you want to get in, and the right direction is the trend. The best possible price is usually through a pullback. Now, as far as I'm concerned, there are two ways to get out. There are two ways to get out of any trade: at a loss, where the market tells you you're wrong, or at a profit, which should be at a multiple of your defined risk, especially if you're trading from a trend-following perspective. So again, when you lose, and losses are, to be expected in any type of trading, you should not be afraid of losses. Losses are part of trading, and as long as those losses are kept to a minimum, and preferably they're lower, they're smaller than your profits, then it's acceptable, because what we're trying to get to here is net consistent profitability. Okay, you don't need to be profitable on every single trade, but overall you need to achieve consistent net profitability. Okay, so how do you get out? Two ways to exit in the market. The best ways to do it. If it's a loss, and you cannot avoid losses, but if it's at a loss, it's where the market tells you you're wrong, and I'll show you that in my strategy in a second. If it's at a profit, preferably you want to get out at a multiple of your defined risk. Okay, so these are very, very important. These are my general approaches in terms of entries and exits when you're trading in the Forex market. Okay, that being said, let's move on real quick and move to, this is my general trading principle. Many of you may have seen this before, and if you have, I apologize for that, but this is my general approach to the markets, and then I'm going to get into the specific strategy, but this is how I look at the markets when I'm trading. Okay, so the key principle is TPV. TPV stands for trend, pullback, and breakout. And basically what you're looking for, if you take a look at this very simple diagram, you see number one is the T is trend. Okay, so you're looking for a trend. In this case, it's an uptrend, as we can see from this diagram. But it could just as easily be a downtrend. Okay, it doesn't matter. Uptrend, downtrend, doesn't matter. It's the same thing, just opposite. Okay, in the stock market, you'll see, or you may know that most of the time the bias is to the upside. We're looking to invest in stocks and hoping that they go up, right? Usually. Now in the Forex market, it's completely different. Up or down, same thing, just the opposite. If the euro-dollar goes up, that simply means the euro is going up and the dollar is going down. If the euro-dollar goes down, that simply means the euro is going down and the dollar is going up. So there is no inherent bias in terms of direction in the Forex markets. Okay, so that being said, we have a trend here, an uptrend. Number two, we're looking for a pullback. Why are we looking for a pullback? Because simply that's the best place to get into any type of a trade. So why is it the best place to get into any type of a trade? It's probably, not probably, but it is, you get in at a better price. So if you take a look at this trend here, you always hear buy low, sell high. Well, in terms of a pullback, you're trying to get into the trend, but at the same time, you're trying to get in at a good price. You're trying to buy low in this case, okay? So you're waiting for some type of pullback to occur, and then you're going to get in on a cheaper price, okay, which is a better price. When you're going short in a downtrend, you want to get in at a higher price because that is a better price when you're going short. Now, so that's you watch for a pullback. Now, if how do you know when the pullback's going to end? Well, you really don't. I mean, how do you know that the pullback's not going to turn into some type of a reversal or what have you, or a deeper pullback? You really don't know. Therefore, we're looking for evidence or some type of indication of a recovery of the pullback. Okay, so in this case, that's why I'm looking for the breakout. The breakout is telling me that perhaps the pullback is ending and momentum is once again going to the upside and once again agreeing with the overall trend. That's why I'm waiting for a breakout. I'm waiting for a breakout because I'm looking for a recovery of the pullback. I'm looking for short-term momentum to tell me that, in fact, I'm going, price is going back, or price may very well be going back in the direction of the trend. So once again, identify the trend. In this case, it's an uptrend. Look for the pullback. In that case, it's a minor down move, and then look for a breakout. In this case, it's a It's a move to the upside that agrees with the overall trend. Trend, pullback, breakout. Now, once you get into a breakout situation, in this case, this is represented by this little blue line right here. Once you get into that, once that triggers you into a trade, I'll show you exactly how I get triggered into a trade in a minute. But in this case, we have this blue line representing the entry. We get into that trade. Once we get into that trade, immediately we could set our stop loss level, or where the market is telling me I'm wrong. Let's go back real quick. Two ways to get out. Number one, loss, at a loss, where the market tells you you're wrong. Okay? So, what is this red line down here telling me? This red line is telling me that if price goes further down, takes me out of that stop loss, it's telling me that the market is saying that my original criteria, or my original reasons for getting to that trade are wrong. Because if subsequently, first of all, I get into this trade on a long trade, subsequently the price action comes down and takes me out, that's the market telling me that that turn was not real. Okay, perhaps it's turning into a deeper pullback, or perhaps it's reversing. Okay, so that's where I place my stop loss, right under the low of the pullback. Now, once I have that low in place, then I have my defined risk. So my defined risk is my entry level minus my stop loss level, and that's my defined risk. Once I have my defined risk, then I can go ahead and define my reward. And one way to define your reward is as a multiple of your defined risk. Once again, profit at a multiple of your defined risk. Okay, so one way to set your profit target is you take your defined risk and you multiply it by a multiplier. It could be whatever you want it to be, whatever works for you. 2 times, 3 times, 4 times, 2.5 times, or what have you, of your risk. That's one way to do it. Okay, an underlying principle is risk control through stop loss. So this is very, very important. Okay, so that's TPB. Let's move forward real quick and just show you on a chart. This is a chart of hourly chart of gold. This is from a long time ago, but I just wanted to show you a perfect example. Yes, this is a perfect hindsight example, but it serves to illustrate this approach very well. Number one, we have a trend. This trend is shown by this uptrend support line right here. It's a very good uptrend support line. Also, it's shown by this simple moving average right here. This is a 20-period simple moving average. Now, once we have the trend in place, that's number one. Number two, we're looking for a pullback. So this pullback occurs. So we have this trend in place. We have this pullback that occurs that comes right back to the line, okay, and the line holds. So that is some type of a pullback. After that occurs, I'm looking for a breakout. So I'm looking for a breakout to show me that the pullback is perhaps recovering, and short-term momentum is once again going back in the direction of the overall uptrend. So in this case, and this is just one way to do it, but I have this downtrend resistance line. Okay, this is this little thin blue line right here is downtrend resistance line. I'm looking for a breakout above there. That breakout occurs. I'm getting into the trade on that trigger, on that breakout, because number one, we have an uptrend. Number two, we have a pullback, and I'm getting in on a good price. Number three, we have a potential recovery of that pullback in the breakout, and short-term momentum going back in the direction of the trend, and therefore again I get triggered into a trade on this breakout. Once I get triggered into the trade, I place my stop loss at this red line right here, which is right below the low of the pullback, which is telling me that if price subsequently goes ahead and hits it, then I was wrong and I'm out of the trade. Okay, so then I have my my defined risk right there, and then I could go ahead and define my reward as a multiple of my risk, and there you have a potential profit target right there. You could use many different ways to choose your profit target. This is one way to do it, to use a multiple of your risk, but of course you don't have to use it that way. But generally speaking, this is my these are my key principles for trading. Trend, pullback, breakout. Very, very simple, very, very powerful, and the strategy I'm going to show you in a second conforms to it almost exactly. Okay, so let's move forward real quick, and let's talk about multiple time frame trading. One of my favorite approaches, one of my favorite strategies for trading in the Forex markets. Now, This is a very logical, high probability style of trading that I've been using for many, many years. Now, many Forex traders use it, and many traders in other markets use it as well. It's purely technical trading, so you're not going to be paying any attention to the fundamentals with this particular type of trade. What it does is it positions you in the direction of the overall trend while pinpointing optimal entries, the best entries. And where, again, are the best entries? They're on recoveries of dips, recoveries of pullbacks. In an uptrend, they're on recoveries of dips. In a downtrend, they're on recoveries of rallies. I'll show you this on my charts in a minute. So we want to position ourselves in the direction of the overall trend while pinpointing optimal entries, the best entries. We want to seek agreement in the time frames. Okay. Now, this type of trading keeps traders out of low probability trades and puts them into potentially higher probability trades. The general idea has three components. Number one, as I mentioned, trend. Okay, we're looking for the trend first. If there's no trend, we're not trading. Number two, we're looking for a pullback. Okay, in this case, not only are we looking for a pullback, we're looking for a pullback recovery, which means a pullback. Let's say there's an uptrend, a pullback occurs. That means price goes down. Okay, a minor down move. And then we're looking for for that pullback to turn back up and go in the direction of the general trend, and then we're looking for a breakout in the direction of the trend. Okay, and I'll show you some interesting and very useful techniques in a minute to put this into practice. Now, the risk management on this is very solid, very straightforward, and I'll show you that in a minute as well. Okay, so how do you choose your time frames? Well, basically, we're going to have three different time frames, and we're going to use three different time frames to look for trend, look for pullback, and look for breakout. Now, these time frames, these three different time frames, first you're going to choose your middle time frame. Okay, so we choose a time frame that you feel comfortable trading. Why do we do that? Because there are long-term traders, there are short-term traders. Whatever you're more comfortable trading, this works on different time frames. Whatever you're more comfortable trading, then that's what you should be. So if you're a longer-term trader, then you should, look at, you're probably looking at the 1 hour chart or the 4 hour chart or the daily chart. If you're a very short-term trader, you may be looking at the, the 1 minute chart or the 5 minute chart or what have you. Okay, so whatever it is that you feel comfortable with. Let's say I'm a 1 hour trader. That means I like to trade the 1 hour charts usually. Okay, which I often do. Now, in order to get my long-term time frame, I'm simply going to multiply my intermediate time frame, which again is the 1 hour. I'm going to multiply it by 4, 5, or 6. Okay, and so let's multiply it by 4. Okay, to make it simple. So I have a 4 hour chart as my long-term chart now. Okay, and my intermediate chart is again the 1 hour chart. Now, in order to get the short-term time frame, I'm simply going to take my 1 hour chart, my intermediate time frame, and divide by 4, 5, or 6 to get the short-term time frame. So let's divide it by 4 and get the 15-minute chart. So so now I have, for my three time frames, my long term is my 4 hour, my intermediate term is my 1 hour, and my short term is my 15-minute. And those are my three different time frames. Now, why do I say 4, 5, or 6? 4, 5, or 6, it gives you flexibility because you're not going to have that many time frames on your platform. You could. I mean, on MT4, on MetaTrader 4, we don't have, a ton of different time frames, so you're going to have to play with it according to, what's available. Okay? There's not a huge amount of difference in terms of multiplying or dividing by 4, 5, or 6, but there is flexibility there. Okay, so some examples. Let's say you're a 4 hour chart trader, okay? 4 hour chart trader, you multiply by 6 to get the daily chart, which is the 24 hour chart in the Forex market. And you divide by 4 to get the 1 hour chart. That's one combination, let's say. Okay, if you're a real long-term trader, let's say you're a daily chart trader, then you want to say, get your long-term chart. You simply multiply by 5 to get the weekly, divide by 6 to get the 4 hour, and there you have your combination there. If you're a shorter term trader, let's say you're a 10-minute trader, okay, you're a 10-minute trader. So you multiply that by 6 to get your long term, which is the 1 hour. You divide your 10 minutes by 5 to get the 2 minutes, and there you have your combination there for a short-term trader. Okay, so that's how you choose your time frames. Now, what do we do with these time frames? That's the most important question here. So let's move over to what we do in the long-term time frame. Now, very simply, what we do in the long-term time frame, this time frame is only for showing you whether or not there's a trend. Okay. Now, this time frame keeps you out of the low probability trades, which are the trendless trades, and gets you into only, what I deem the higher probability trades, which are the trend trades. So the only function of this time frame, once again, is to find the overall trend. Now, the tools we use to find the overall trend include, the correct order of moving averages. There are other ways you could do it. You could use trend lines. You could use, single moving averages. You could use the slope of the MACD histogram or what have you. But I like to use the correct order of moving averages, and I'll show you that in a minute. So on your long-term time frame, if you see that there's no trend, then you stay completely out of that particular currency pair. Okay? If there is a trend, then we could drill down to the intermediate time frame. Okay? So and we decide that if there is a trend on the long-term time frame, then we're only going to trade in that direction. Now, let me show you this right here, correct order of moving averages. Okay, this is called COMA. Okay, it's sort of a ridiculous acronym here, but it works. Correct order of moving averages. And this simply means that you are in a correct order for a trend. It's showing you whether or not there's a trend. Now, if you take a look here, I'm not sure if you can see my mouse, but my mouse pointer, but if you take a look here on an uptrend, we see that we have 5 different moving averages here. They are in correct order. This means there is a trend. So if you take a look at this black one here on the left-hand side, on the bottom, that is a 100-period moving average. Then we go to a 50-period moving average. Then above that is a 30-period, then 20-period, then a 10-period. These happen to be exponential moving averages. Once again, 100, 50, 30, 20, 10. So these are my moving averages here. They're in correct order for an uptrend. The correct order for an uptrend is simply the longest term moving average on the bottom, followed progressively higher by longer term moving averages. Okay, so that's correct order for an uptrend. The correct order for a downtrend is just the opposite. We have the 100-period in black over here on the right. 100-period on top, followed lower by the 50-period, then the 30-period, 20, and 10. So that's the correct order moving averages for a downtrend. Okay, in between where you have moving averages that are crossed and that are not in correct order, then we're not even going to call that a trend. If you could take a look right here, this looks like a downtrend right here, right? But I'm going to follow my rules, and I'm not going to call it a downtrend because I don't have correct order moving averages. Yes, this could very well be tradable as a downtrend. This could very well be a very nice downtrend that you could trade into, but I'm going to follow my rules. Okay, so I'm only going to trade when there is correct order of moving averages, and I really want to stress this fact that you should really follow your rules. If you have rules that have worked for you and that continue to work for you, then you should follow your rules. And despite what you may see on the chart that, yeah, this looks like a downtrend here in hindsight, but during that time there was not correct order of moving averages, and therefore I'm not going to be trading that particular market. Okay, so that's correct order moving averages. So we want to see correct order moving averages. Once we see that there is correct order moving averages, and again, if there is not correct order moving averages, then we will not be in that particular currency pair at that particular time. But if there is a correct order moving averages, then we drill down to the intermediate time frame. Okay, what do we do on the intermediate time frame? Now, what we do is we use oscillators. Okay, and a lot of people talk badly about oscillators because they think that they're lagging, which they are, and all they are derivatives of price, which they are, and that's fine. However, they give you some useful information. Okay, they give you some useful information as to momentum exhaustion, and that's how I use them. Okay, I use them in that manner to give me some type of an indication that perhaps there's momentum exhaustion there. Yes, they're lagging. Yes, they're just derivatives of price, but yes, also they provide some useful information. Okay, so what do we do with this? What I usually use are stochastics. Okay, I use slow stochastics, and I'll show you my settings in a minute. But what do I do with these stochastics? Now, if the overall trend is up on the long-term time frame, I'm looking for turns to the upside from oversold. Okay, and that's telling me that perhaps there's an exhaustion of the pullback. Now, if the trend is down, I'm looking for turns to the downside from overbought, and that is telling me that perhaps there is an exhaustion of the pullback to the upside. Okay. Now, this practice finds the optimal entry regions, which are recoveries of dips and pullbacks in the direction of the trend. Okay, we're looking for minor down moves during uptrends and minor up moves during downtrends. Okay, I know this may be confusing, especially for those of you who are beginners, but rest assured I will show it to you on my charts in just a minute. Okay, so that's what we do on an intermediate time frame. In an uptrend, I'm looking for the stochastics to cross up above oversold, and that's telling me that perhaps this dip is ending. In a downtrend, when the price goes up, and rallies up, I'm looking for the end of that rally, and I'm looking for the stochastics to cross down below oversold. I'm sorry, overbought, and that will give me some indication that perhaps this recovery is ending. Okay, now once that occurs, once that cross occurs on the stochastics, then I'm looking for a short-term time frame. And the short-term time frame is used simply to pinpoint entries and exits. Okay, we are looking for what's called a trailing entry stop. Okay, and I'll explain this to you. I'm not going to read all this because I'm going to explain it to you how exactly it works visually. Now, this method gets you in at progressively better prices. Okay, now once you get into that trade, you want to place your initial stop loss right beyond the pullback. Okay, and that will show you when the market is telling you that you're wrong. Okay, so let's go to the charts real quick. Hopefully you all stayed with me here. Okay, great. There are a lot of you in here. Again, if you have any questions, please feel free. Okay, great. No questions yet. Okay, so let's start real quick and go to this is a historical example, but just to illustrate the point to you. Okay, first of all, I've got three different time frames here. I got the daily, 4 hour, and 1 hour on the euro dollar. Okay. So once again, daily, 4 hour, 1 hour. Daily is my long term. 4 hour is my intermediate term, and the 1 hour is my short term. Okay. So first we're looking at the daily chart. Okay. Where this arrow is where we're looking. Okay. So we're looking. First of all, we're looking for correct order moving averages. This happens to be a 100 period, as I mentioned. Then we go up to 50 period, then a 30 period, 20 period, 10 period. This is a correct order of moving averages at this particular time. If we move over here, this is not correct order of moving averages. These are crossed, and therefore we're not even going to be considering any trades in this area right over here. Okay, but this area right here is good for being within a trend. We are within a trend. All along here, we are within a trend. Okay. But let's just take a look at right here. We could just as easily have taken a look here, or here, or here, or here. All along this line, we could have been looking for some type of a trade. Okay, so that is we're in a trend. Now, once we're in a trend, according to the correct order moving averages, then we drill down to the intermediate chart. In this case, the 4 hour chart. Now, this is exactly what I'm looking for right here. This is the same time frame as the long-term chart, but this is what I'm looking for. I have a stochastics here. In this case, I have a 1433 stochastics. What am I looking for? I'm looking for stochastics to emerge from oversold. Why am I looking for that? Because there was a dip here. There was a dip here. Okay, this dip was shown by stochastics going into oversold, and then when it emerged from oversold, that's telling me that perhaps this dip is exhausting itself. Within this uptrend, this dip moved to the downside, and by this moving up here, perhaps this dip exhausted itself. Okay, maybe, maybe not, but it's showing me that there's an indication that perhaps this dip exhausted itself. So once I have that, okay, then once this cross occurs, then immediately I'm going to drill down to the 1 hour chart, which is my short-term time frame. Now, let's say the signal where the stochastics crossed above oversold on the intermediate chart occurred right over here. Let's say it occurred right over here. Now, What am I looking for here? I'm looking for a breakout. I'm looking for a breakout right above the last candle. So let's say I'm on this candle, this red candle right here. I'm looking for a breakout above the prior candle on the 1 hour chart. This is my short-term chart. So I'm looking for a breakout above the prior candle. If that does not occur, well, first of all, if there is a breakout above the top of this candle, I'm going to get into this trade long, okay, with the trend. That's my breakout. Okay, I'm going to get in there. But if it does not break out, then I'm simply going to move my breakout level lower. So now we're on this particular bar right now. Now I have already moved my breakout level lower. So now I'm looking for a breakout above this red bar here. Still doesn't happen. Okay, there's no breakout above this prior prior high to go high. So now I'm on this bar down here. Now I'm on this green bar down here. I'm looking for a breakout above the prior bar, above the high of the prior bar. I had already trailed my entry level lower. Now I'm looking for a breakout above there. It does not happen. Okay? Again, it does not happen. Now we're on this next bar. Now, I'm sorry, let me just do this real quick. Oops. Okay, now we're looking for a breakout above this bar now. Above this bar right here. Finally, this breakout occurs and I'm in the trade. I go long on a breakout above this bar right here. Okay, this candlestick right here. Now, what did I succeed in doing this now? Okay, I'm looking for breakout momentum. I'm looking to go to the upside. Again, on the daily chart, we're in an uptrend. On the intermediate chart, we have a recovery of the pullback, so a move to the upside. So that's agreement of the long term and the intermediate term. Now I'm looking for the short term to agree by breaking out. Now, if it occurred here, on this red bar right here, I'm looking for a breakout above the green one, above the prior one. Doesn't happen. So then I move the breakout level down to the high of that bar, and then on the next bar, I'm looking for a breakout above that one. Doesn't happen. Okay, finally it happens. Now, what did I succeed in doing? Okay, I went long, just like I always intended to. I went long, but I'm at a better price now. Because this, the fact that I did not see immediate momentum in the direction of my trade, which is long, which is, buying. The fact that I did not see immediate momentum, I had to wait a few bars. But in the process of waiting those few bars, I also made myself a better entry price. Okay, when you're going long, when you're buying, a cheaper price is a better entry price. Okay, you're buying cheaper. You're buying something cheaper. So I'm moving. So I get in here. That's at a much better price than up here. And also, when I get in on that particular buy trade, then I could place my stop loss below the last low. And this is a this is a pretty tight stop loss right here. Okay, so again, if price subsequently moved down and broke down below my my stop loss down here, that's the market telling me that I'm wrong, then I should get out of the trade. Now, once you get into this trade with this, in this case, which is a long trade right here, then you could ride this out. You take your defined risk, which is the green line minus the red line. The space between here is your defined risk, and then you could do your reward to risk ratio. Your reward should be a multiple of your risk. You could also trail your stop losses. That's another way to do it. But one way that I often do it is to make my reward a multiple of my risk. Oftentimes it'll be 3 times, 2.5 times, 4 times, or what have you. Okay, so that's one example right there. If you have any questions, please let me know. Okay, now let's move on to another one here. Okay, let's move on to this downtrend here. Okay, so this is a dollar yen downtrend. I happen to have daily, 4-hour, 1 hour here. Okay, so now we have correct order moving averages where this arrow is right now. Correct order moving averages for a downtrend. It's also correct order moving averages over here, over here, over here, over here. Here it sort of crosses, but then down here and down here as well. Okay, so let's just for examples, for the sake of this example, let's I have this arrow right here for this downtrend. So we are in correct order moving averages. Then what we could do is we scan the intermediate chart, and we're looking for exactly this. Okay, a cross below over sold. Okay, so once again, think about it. We are in a downtrend. Okay, now we're looking for a pullback, a rally to the upside, a minor rally to the upside, and then a recovery of that rally by this right here. This stochastics showing me a move across below. That's showing me a possible loss in momentum of the minor up move on the rally, and we're looking for a cross to the downside right here. When that cross occurs, that's telling me perhaps there is a recovery of this rally, and perhaps we might be moving back in the direction of the trend, which is a downtrend once again. Okay, so this cross occurs. Then I drill down to my short-term time frame. Now let's say this occurs right over here on this. Let's say we're on this doji candle right here. Okay. Now we're looking for a breakdown. I'm sorry. Let's say it happened on this red candle right here. Okay. So we're looking for a breakdown below there. It doesn't matter where it occurred. Okay. So let's say we're here. It could have occurred right here. Okay. And we look for a breakdown below there, and that breakdown immediately occurs. But just for the sake of illustration here, let's say it occurred right here. Okay. Right where, let's say, right over here. Okay. And it occurred right here. Now we're looking for a breakdown below this, the low of this candle right there. It does not occur, so on the next candle we move it up a little. Okay, so now we're still looking to go short on a breakdown, but now we're on this candle here. We're looking for a breakdown below this candle right here. That still doesn't happen. So what do? Now we're on this candle right here. We're looking for a breakdown below this candle. It happens. So we go short. We got in at a better price. A higher price when you go short is a better price. So we got in on a better price here. We immediately place our, our stop loss at the high of the, above the high of the rally or the pullback. We get in short. That's our defined risk. Okay. So if it subsequently price actually goes back up and takes me out, that's the market telling me I'm wrong, and therefore I get out of the trade. And that is my stop loss, my risk. Okay. Now I could simply multiply my risk amount to get my reward or my profit target, or I could also trail my stop loss, at least trail it to break even, and then from there we could trail it further to lock in profits. Okay. Show you another one here. Okay, same type of thing here. This is a shorter term one, although also a historical example. This is a shorter term one. I have the 4-hour, 1 hour, and 15-minute. Okay, so we take a look here. We have the correct order moving averages for an uptrend here. Okay, we have several different places for correct order moving averages. In this case, we have the moving averages lining up for for an uptrend. Now, once we have that, we could scan the intermediate chart for this right here. Now, a lot of people ask me if it bounces off the. By the way, it happens to be 80 and 20 for the which is usually the default, but 80 for overbought and 20 for oversold. So now people ask me, see, this didn't really go into oversold. It just sort of bounced off oversold at 20. That's fine too. Okay, for me, if it bounces off oversold, that for me is also some indication of perhaps a recovery of a pullback. Okay, so once again, we have the longer term chart, the 4-hour chart, showing me correct order moving averages, where this arrow is right here, and then we go to the intermediate chart. This happens to be the 1-hour chart. We're looking for either a cross above oversold or a bounce off oversold. In this case, it occurs. Okay, and then we know that perhaps we're going long on a breakout. Now we go to the intermediate chart. I'm sorry, the short-term chart, which happens to be a 15-minute chart. Now let's say it happens right here. Okay. Now I'm going in long. Remember. Now I'm trying to go in long here, but I'm looking for a breakout above this little. You can call this a shooting star candle or whatever you want to call it, but above that candle right there. So that does not occur. So I move the breakout level lower. I'm looking for a breakout above here, above this red line here. That also does not occur. Okay, then I'm looking for a breakout above this one. Hopefully you can see this, above this little red candle right here, and it does occur. Okay, so I'm going to get into that trade. Not a great one here. Okay, not a great breakout trade right here, because look what happens. It breaks out, Okay, you get into the trade, you place your stop loss below the last low, you get into the trade, but then it sort of like moves up and down, up and down, up and down. That's fine. Okay, it often happens that way. I'm looking for the best indication possible that there is momentum in the direction of the trade, which in this case is long. But if it breaks out, then it doesn't really do what you want it to do immediately. That's part of trading. Okay, you have no way of knowing exactly when that momentum will occur that it will go in your direction. Okay, or when it could stop you out. In this case, it goes in your direction, but then it sort of fluctuates in a range, which is always very frustrating. But you've got your stop loss, and you've got your potential profit target in this in a multiple of your stop loss. A multiple of your risk, and then you could also lock in break even, lock in profits by moving your stop loss, and eventually this goes in your direction. But this place right here, not the perfect trade, but a trade nonetheless. Okay, let's see if we have any questions here. Okay, we have, could we get the, let me see, okay, good morning. Could we get the PDF files of your presentation? Yes. If you would like, please email me at jchen@fxdd.com, jchen@fxdd.com, and I'll be happy to send you my my PowerPoint presentation. It's not a PDF, it's a PowerPoint. Okay, where did you find your stop loss in the 1 hour time frame? I'm not sure which chart you're looking at, but the way I find my stop loss, Alex, is very simple. Once I get into the trade, okay, let's say I'm going in long on this pullback trade, okay? So once I get into the trade, I'm placing my stop loss simply below the low of the pullback. You could say 1 pip below, 5 pips below, whatever you want to, however you decide to do it, depending also on your time frame. If you're on a very short-term time frame, you could, perhaps say 1 pip below. If you're on a longer-term time frame, maybe it could be, more than that. It's really up to the way you decide to do it. But that's how I set my stop loss. It's when the market's telling you you're wrong. I mean, when you're looking to play this recovery of the pullback, if price subsequently takes you out of your stop loss, then you're wrong, and you get out with a loss. PDF, yep. I'll send you the PowerPoint if you just email me, jchen@fxdd.com. Klaus, are you using simple moving averages exclusively? No, actually what I was using on this is these are exponential. Let me see. Yeah, these are exponential. Chat, how do you define a breakout? A breakout is just a breakout above the last high. Okay, in this case. So, if we're looking at this last candle, this red candle here, it's just a breakout above the high of that candle would be a breakout. Mulaji, stop loss trailing on what time frame? Oh, okay, good question. Stop loss, I would trail it on the shortest term time frame. Chetan? Is it only wicks that you consider a full close? I'm not sure what you're referring to, but I think you're referring to when I'm looking for a breakout. I'm looking for a breakout above the high, which would be the wicks included. How do you gauge the trend is, Song asks, how do you gauge the trend is close to ending? That's hard to do, okay? That's very hard to do. It's very hard to gauge when the trend is close to ending, when it's going to become a reversal, or when it's just in some type of a pullback. Therefore, you just have to follow your rules. If you have, let's say, a rule of following the correct order of moving averages, then according to your rules, the trend has ended when there's no longer correct order of moving averages. Jose, what's the best indicator to trail your protective stop? I would use price action. Okay, it could be based upon, let's say, you have a defined risk. Okay, maybe at 1 times your defined risk. When you go into profit, at 1 times your risk, when you're in profit, then you could perhaps take your stop loss to break even. That's one way to do it. And then from there, if it goes to 2 times your risk, then you could take your stop loss to 1 times your risk in profit. Okay, hopefully that makes sense. Ellis, is this going to be left up that we can go over once more? I'm not sure. I think Dan at Traders Log has recorded this. If not, you could always get my slides. Oliver, by moving your entry level lower and lower, are you not ignoring significant support or resistance? Good point there. Very good point. And, you know, Ward, I'm sorry. Let me see. Oliver, I'm sorry. Oliver, by moving your entry level lower and lower, are you not ignoring significant support and resistance? Yeah, great point there. Now, what I failed to mention, or I forgot to mention, was that you can't just keep moving your your entry level lower and lower. Okay, you want to be able to move it lower and lower to get it at a better price, but you can't just do that indefinitely, because if the signals on your higher time frames, your 2 higher time frames, are turning out that they are you know, becoming invalid, then at that point I'm going to abandon the trade. I'm not just going to keep moving my entry level lower and lower until it hits. Okay, I will do it as long as I will move it lower and lower, as long as the higher time frames are still showing a valid signal. That being said, also you know, absolutely, Oliver, you might want to take into consideration support levels as well if you want to, you know, if you want to take that into consideration as an additional criteria for getting to trades. Alex. Okay, Andre, do you use candles as confirmation indicators at all? Yeah, absolutely. If you take a look here, this is a nice little hammer candle here. I mean, it's not great, but you know, we have a long lower wick here. We also have a long lower wick here that didn't turn into a nice, a really good one. But here we have a nice little hammer type of candle here. Basically, these long wicks are telling you that you know, price is having a hard time moving forward, you know, moving further down. Okay, so yeah, you could certainly use wicks as confirmation. Mira, can you please give me the email address? Yeah, it's a PowerPoint, and my email address again is jchen@fxdd.com. jchen@fxdd.com. And there should be a recording of this presentation. Do you have to wait for the bar to close above the high or below the low to qualify it as a breakout? Yes. Do we have to wait for the bar to close above the high or below the low to qualify it as a breakout? Yes. That's what I would qualify as a breakout. What is the setting for stochastics? Setting for stochastics in this particular case, 1433. Okay, great. I think that's pretty much it. And you know, hopefully you got some use out of this webinar. Again, I believe Traders Log has, Dan at Traders Log has recorded this. If not, please, you know, please feel free. Oh, I'm sorry. Dan says yes, he has. Okay, so you could go to traderslog.com to access the recording. And again, if you want the presentation, just email me at jchen@fxdd.com. Thank you so much for your time, everyone, and thank you, Dan. Thank you, Traders Log, and I wish you the best. Best of luck in your trading, and have a great day. Thank you.